liquidity providers. Right, if you have gone through the public library, I've talked of the liquidity providers. We have the tier 1, tier 2, and the market makers are within the tier 2. So they can place a trade, but also they need to stand on the other side of the trade in order for the contract to be complete. So anytime you enter your buy order, it will quickly be taken by the market makers, and your order will be, and the contract will be complete. And in providing liquidity, market makers usually look on the number of orders that are placed. If they can match them, then that will be the first phase of liquidity. So if you enter your buy and someone else enters sell at the same price and at the same time, then they'll quickly match the two of you. So that will be the first liquidity. And if on the other side is someone is not there, then market makers would come into play. So that's how they provide liquidity. So in investing, we have what we call the fair value prices. In these financial markets, we have what we call the fair value prices. Fair value in general refers to the asset sale price agreed upon by a willing buyer and a willing seller. So a willing buyer wants to buy at a price maybe at $150, and the willing seller wants to sell the asset at $150, and can be an asset or service. So if the two are knowledgeable and enter the transaction freely, then we can call that price a fair value price. And in the financial markets, the price that you will be seen, at a particular time, that is a fair value price, because the financial markets help us in price discovery. And we have speculators, we have traders, investors, and these people buy and sell at their own price, their own willing price, their own willing time. And in the latter, you see the demand and the supply would give you the fair value price at which many have entered buys and sells, and eventually the market will give you a fair value price. So when we go to the stock market, for example, here in Tanzania, we have the stock markets, and the prices for the stock markets usually have a change in terms of see, the change in prices is not the same as in the Forex market. See, in order for price to jump maybe from 700 going to 800 per share, so this is the share price, it needs to be jumping in an increment of 5. So it will go to 705, it will go to 710, until it reaches 750 until 800. So there will be increments of 5, and in order for this increment to be there, then buyers needs to enter maybe at least 1 million contracts. So maybe at least 1 million contracts need to be traded as buys in order to rise the price. So the price will rise that way. So there's a certain threshold that needs to be met in order for price to rise. And in Forex now, we have the smallest change in price, which is called a pip. This is USDJPY. USDJPY usually a pip is measured in 3 decimal place, but in other currencies we have a pip as a change in 4 decimal place, so 0.0001. 0001. So a change in price at this decimal place would be called as a pip. And for a move in 1 pip, there's a certain threshold that has to be reached in terms of contracts. And it's according to Mauro, it's around 10,000 lots. And 10,000 lots would be around, one standard lot is around 100,000 contracts. So 10,000 would be like 100,000 times 10,000. So in order for 1 pip to move, so if you see price going down, that means the large speculators, see the large speculators are the ones that move the market. But for small traders like us, our lot sizes doesn't matter in the market. See, we do not move the market. But if large speculators enter their orders, then you'll see price going down. So if they sell, then you see price going down. And each price now has to be a fair value price as what we've seen in the stock markets. For example, for someone who needs to buy at 705, there has to be a seller at 705. So the same is to the Forex markets. For a change in PEEP, so if someone enters sales, then someone else has to enter buys in the same price. So each level in price has to be a fair value price. And the candlesticks can highlight on how these fair value prices come into play. For example, here we have we had buyers at this level here, and these candles here shows that only bulls existed there. But then when price reached here, we see that sellers came into play. See, these sellers came in to fill what buyers entered here. See, with these candles, we know that they were willing buyers at this price. So market makers usually come to reprice to these levels in order to fill these prices to become fair value prices. And then you see buyers again. We have fair value gap here. So if you see a gap where only a buy side liquidity or a sell side liquidity is seen, then that's a fair value gap. And eventually price comes in and fill these gaps. And if you see this downtrend, every candle, you see this red candle, it closed down here. And then the open of these, market makers came back to reprice to these levels to fill in the fair value gap and then continue to sell. Another one here, we see market makers come in to fill the fair value gap. And then the market eventually did sell. And here we had another fair value gap. And then we see buyers came in. So you see this downtrend, you see from this point to this point here, we only have fair value prices. At least here we had a fair value gap at this point. So if there are missed levels in price when the market is trending up or is trending down, then the market will find a way to fill in these prices to become fair value prices. And if now, if this range is big or wide, then that creates a void in liquidity. So that creates a big gap in liquidity, and the market will seek to fill in these gaps. So if you see a void in liquidity in a certain area, maybe in a half hour time frame, daily time frame, then you have to anticipate for an impulse swing, for a retracement to that level. So retracement in the market simply means a willingness on the part of the market makers to reprice to levels not efficiently traded for fair value. So this was an example. This was USDJPY. See, we have one side of buy liquidity. So this creates a void in liquidity, and eventually the market comes in to fill it. And your next target, when the market comes to fill, should be the next order block after the fill. Like here we had a bullish order block here. And this is sell side liquidity. Here we can see it on the daily. On the daily we had a void here. See, market makers came in, ran into an area of stop losses, and then eventually reversed. So this, from this point here to this point here, we had fair value gap, and you can see the market came in to fill the gap. This is it's not a gap; it's actually a void. So came in to fill, and the target was this bearish order block here, and this void is what we have seen on the R4 previously. And the market came in to fill this, and you see the target was this bullish order block here. So there's no specific rule on how this on how the market will come to fill in this, on the timing and all that, but you should understand that eventually the market will come to fill in these voids. And when you're anticipating areas of resets, maybe on the daily time frame, we usually look on the fair value gaps and the voids, and would give you specific price level, and you would see sometimes these levels would match with the EMAs or certain quarter points. Now that's all about the fair value gaps and the void of liquidity. Now let's talk on pools of liquidity. In order for the market to reverse, so if you see a reversal in the market, it simply means market makers have run into a level of stop losses and pending orders, because in order for the market to go up, then market makers have to enter buys, and eventually the market will move up. Now, in order for them to enter buys, then the other side of the market, there must be sellers. So if you see like the dealer is forming a peak, you see clean equal lows, you should understand that down here there are sell stops. And this sell stop simply indicates that there are willing sellers at this specific price. So if the market makers come in and register the sell stops, that means they will be entering their buys, and they found willing sellers, and eventually you find the market reversing. And this retracement here, when the market retraces, it allows stop losses and pending orders to be placed below or above a newly established high, below a newly established low. And then market makers, smart money, would like to rate those stop losses. So liquidity pools reside above these clean highs and these clean lows. So above newly created high, below newly created low, is an area of buy stops and sell stops respectively. So when the market rates it, it is wise for you to sell to this point. At this point here, because you find willing buyers, it is wise for you to buy at this point, because you find willing sellers. And if you are trading the peaks, like we know the market has levels, so the dealer has formed a peak here. It's come to rate this, and you're not taking your trade, your buys, Then your next area of your next target should be an area above here. So you look for maybe the ADR if it's above here, or a certain quarter point or a certain EMA, and that should be your first target. You would see the market coming back to retrace to allow people to enter their pendings there, and then eventually they'll come to raid it. So that's how you would know that a level is complete. You see, I will only count a level if it has broken a previous high or a previous low. So if it's an uptrend, if it has broken a previous high like here, seeing the market has broken this, so that would be a level. So you should, we have learned on the support and resistance points. And in these areas where we find support and resistance points, we should be very careful on these areas because the market makers may, you need to see that the market makers have raided a pool of liquidity. So they've tapped the liquidity, and then there now, you will be at least 90% sure that the market would now reverse. So we have this as an example here. We had clean highs here. And here we had the initial high. So the market makers came to raid in stop losses and pending orders above here, and then formed a peak there. See, here we had equal lows, and we had a peak. See, these are the kind of peaks that I usually don't like because I've not seen the market makers tapping liquidity down here. But eventually the market reversed, and here we had a pool of liquidity above this side, and then the market reversed. Again, we had a pool of liquidity down here, and eventually the market reversed. We have another example here of Euro card. This was a very good flash card for these pools of liquidity. Like here we had high, the initial high here. Market makers came to raid. We had lows here. The market makers came to raid in. And here we had another raid up here. And then we had levels here. See, at this point, someone may think that this is a point of reversal. See, this is a very good support area. And market makers gave in. They had a retracement to these EMAs, and then eventually they came in to raid this pool of liquidity. But then we had another low here, so this was also a pool of liquidity. And you see, after raiding these two pools of liquidity, the market quickly reversed. And here we had, I think it was card news. Eventually the market reversed and came in to raid this pool of liquidity up here. So if you see that the market is reversing, it simply means that market makers have raided these pools of liquidity and they are now willing to reverse. And you see this peak here. We had equal highs here. We had equal lows here. See, the market makers came to raid in. Again, they came to raid in down here. And then eventually the market reversed. The same was this was called JPY. So that's all about these pools of liquidity. And you can plot these pools in any time frame. In the 15 minutes time frame, I usually look for these clean lows and clean highs as the market is moving. So when the market is forming maybe a W or an M, I usually plot it. If it's a clean M or And a clean M means it has equal highs, or a clean W maybe it has equal lows. And I've entered the orders there, and I've seen in 2 hours the market is not moving as I expected. I'm not in a significant profit. Then I will reduce the risk there, because I'll be having another view, like the market would simply come to rate the stop losses below or above, below the W or above the M, and then form another pattern for a reversal, and that would be a good area for reversal. Now let's talk of the power of three. So in the power of three, here we are talking of the basic characteristics of any market. See, the markets would accumulate, and here we'll see a consolidation. And when the market is consolidating, market makers will allow orders to be built on both sides of that price range. And so we have a price range here. So market makers will be allowing orders to accumulate on both sides. So before they go to an expansion, so here they're accumulating. Before they go to an expansion, maybe they want to buy. They'll first maybe take the buy stops that up there and come to take the sell stops down here, and then eventually they reverse. So we in the accumulation phase, we can have the consolidation and the stop and the Judas swing. So after the market has raided these areas, then you see what we call the profit relief phase. And you need to be within this in order to benefit in this market. So the profit relief phase is usually a range expansion where profit is permitted. So you see that the market is now reversing, going up, and then you see 3 levels up. And then eventually when the market makers reach the area of reversal, they'll be distributing the longs and shorts, and there is where they'll come back to consolidation. And then the accumulation phase will start again. So in any market, this usually happens. And let's now look on the daily basis. Like this is a standard daily bar candle, and this is a downtrend, and this is an uptrend. So on the daily basis, this is the Asian Open here. We had the accumulation, and then the market makers would try to raid the buy stops up here, and then after grabbing the liquidity, you find them forming a pattern, and then this will be now the profit release phase, where you see 3 intraday levels, and then eventually the market would come back to rest. And here is where the market makers will be distributing longs and shorts. And then you have the market close there. And here we have a bull candle. Here we have the accumulation. This is where the day opens, and here market makers will like to raid this stop losses and sell stops down here, and then you see a range expansion. And so clear 3 levels up, then eventually the market will come to rest. And there we have the market close. So on the daily basis, this is what will happen. And this is an illustration. Here we have the accumulation phase, where the dealer will set the initial high and the initial low of the day. After setting this, the dealers will allow orders to be built on both sides. And then we have a total stop, total soup stop rate. So this will be the first rate. And then the market makers would eventually sell. And this hunt here, this Judas swing going down, would go to a previous imported high or low. And can be a previous daily low, a previous daily New York low, a previous day high. So this top end can also be a previous day high. And it's only be a previous day high when, see when on the previous day, maybe you had an uptrend here. And then when another session, when Asian opened, On the Asian, the market also moved up and then accumulated a bit. And then on Asian Open, you find this red here, and they will come to this level, form a pattern there, and then move up. Or maybe we had, okay, that's a good example there. So after this top rate, at this area is an area for optimum trade entry, because at this area we know that market makers have now accumulated the liquidity they need, and they can now reverse. And then you see three intradays, and this is the New York gap time. Usually the session changeover, we have a trap move. So come to talk of it on the market making. And then this might be a New York entry. And then the market makers would have ADR complete. And for a down trade, it will be an exact opposite of this. So the stop hunt will come to a previous day high, previous day New York high, New York low, previous day low. And we have a turtle spread soon after Asian close, and then we have a stop hunt high. This is an area for trade entry. We have 3 intraday levels called down, and this is the ADR complete. And this now is the flash card. We have a good accumulation. This was USD Swiss franc, a range of 11 pips. And right at gap time, we had a turtle spread going up. And then the market makers came down to a previous day low. From the pattern there, we had 3 intraday levels going up, and the day did end off back to consolidation. This was Euro USD. So this is an example of a downtrend. We had a turtle spread down here, clear 3 intraday levels going to previous day high. A pattern was formed during session changeover going to New York, and 3 intraday were seen. Eventually, the market came to rest. And now let us go deep into this this top hunt high before the range expansion. Stop hunting to the market makers is a strategy. A strategy that attempts to force some market participants out of their positions, and they do this. Simply, they drive the price of an asset to areas, to levels where many traders have chosen to set their stop loss order. You see, market makers benefit from the spread, but also the losses from the retail traders goes to their pockets. So they also benefit from losses from retail traders. So triggering of stop losses and raid of these sell stops and buy stops simply leads to high volatility, and there is where we need to seek to enter our trades. And there is where our second leg M or a second leg W comes into play. And we can also define stop under the sharp move towards the high or low. And this, we talk of the previous highs or lows, and this can be previous daily highs or daily lows, previous monthly, weekly, yearly highs or yearly lows. And the larger the time frame, the larger the stop hunt. Usually during seasonal moves, we have larger stop hunts. And how can you identify the stop hunts in the 15 minutes time frame? We usually look for 3 swipes going to the low or 3 swipes going to the high on the 15 minutes. And the last swipe has what we call 1 minute 3 inducements. So we have 3 inducements here, 1, 2, 3. So this is the last swipe here. And this was gold. We had a very good accumulation. Total super raid, and we had 3 intraday levels going up. And here the market makers formed a pattern on this blue tracer. So when you go to the 1 minute and look upon this last swipe, you can clearly see three inducements, 1, 2, 3, and then a pattern was formed from there. And here we had 3 vector candles. Sometimes you may not see three swipes. You may see 3 vector candles, and these vector candles, when you go to the 1 minute, you find 3 swipes going low, and then a pattern will be formed there. Here we had a very good, this was the accumulation phase that also prayed going up, 3 swipes going to the low, right on that stop and box. So this was a clear 3 swipes going to the low. And there we have to see the pattern. See the last swipe when you go to the 1 minute had 3 inducements, and we have seen the pattern is there. And then eventually the market reversed. So
when you are saying this 3 inducement in 1 minute chart, it is 3 level of drop.
If the 3 inducements would if the 3 swipes, the stop band is going down, then this last part would be like 3 levels going down. You have
the last part.
Yes, 1, 2, 3. We are talking of the last swipe on the 15 minutes time frame. So this will be the second part, maybe, and this is the first. But when you go to the last part, we have what we call the 3 inducements. So that is all about the liquidity. Can you hear me?
Can you just open the yesterday I sent you some flashcard? No, you said it is wrong. So if you can just.
We need to look on the.
Yesterday I sent you the card, the flashcard.